everyone. Mark and I are here with Harold Smith. He is the lender with Legacy Mutual, and thank you for coming.
You bet.
We appreciate
Thanks for having me.
So I've got a question for you. So
Okay.
One of the number one questions I get from people is, okay, we're ready to buy, we're ready to move up or move down, whichever
Right.
it is, but we have a house to sell. We don't want to move twice. How do we do that?
Yeah. Wouldn't that be nice? I want to go find the dream house,
I know.
and I will just move the boxes from here to there.
Well, and sometimes we have a little wiggle room on our end to help with that, as far as trying to maybe do a lease back and let them stay in the house a longer while they get the second house done, ready to go. And in a perfect world, when that works out, it's amazing. But from your side of things, what's your magic?
Okay, so good question. So let me be very clear. It does depend. There's no 100% magic wand that I get to use to go, oh, here you go.
Sure.
Right, I wish it was. So it does depend on their income and their assets, and we have to run some formulas and math to be able to figure it out. But no doubt, it's a common question because it eases their stress. Now, I say that, and sometimes people go, oh, but you will then realize you're going to own two homes at the same time. Yeah. And that stresses them too. So sometimes people are like, oh, I do want to sell, even if I could, it stresses them out. So I see it both ways. But here's a couple of things that we typically do. So one is, most of those clients are going to have a lot of equity in their current home. And of course, there's a couple of strategies. Maybe they've got other savings, or maybe we temporarily borrow from a 401k or a retirement account. There's a couple of different techniques that we look at. What are their other assets they could maybe tap temporarily to maybe do a down payment on the next house? This is assuming their debt ratios work to carry both homes. And then now they're thinking though, but then I'll have a much bigger mortgage. Temporarily, yes, you probably would. Okay. Well, but then we get into the next house. They could sell their current one. Well, then they could use the proceeds to replenish maybe a loan against a 401k or a retirement account, or maybe there's a thing called a securities-backed line of credit. I work with a lot of financial planners, and we structure those sometimes. That's where they take some assets that they have and they set up a line of credit against it. Okay. So they temporarily borrow against it. It's a pretty easy thing to do. So then they could repay those, get those paid back right after they sell their house A. Then maybe they have still more money and they want to lower the loan balance on their new loan. Well, there's a concept that this is the number one thing that I find people are surprised about. When I explain this, they go, I usually hear, I've never heard that. Yeah. And it's called recasting. Yeah. I know we've talked about this before. Yeah. So here's what people hear of recasting. It sounds like refinancing, but it's not. So we know what refinancing is. That means you've got a new loan that will replace your current one. Usually we think of that like, the rates went down, so we improve it there, or we do a cash out. Recasting is different. Recasting is not a new loan. Okay. Let's just make it really simple. Let's say somebody has a mortgage of $400,000. Okay. And let's say that they sell house A and they want to lower the balance on house B. Maybe they've got $100,000. They want to lower it to $300,000. They can totally do that. There's no penalty to do that. They can totally pay extra. What happens, the default is, so they've got this, let's say it's a 30-year loan of $400,000. It will gradually torque downward. Well, the default is if you paid the $100,000, you shorten the length of the loan. So now it's not 30 years. Maybe it's, 20 years, whatever. Okay, shortens the length of the loan, but the payment stays the same. Okay, but that's advantageous. Some people are like, then I get it paid off faster. Some people want that. Some people, though, want the opposite. They want to be able to pay that big chunk and have their payment drop. Yeah. Totally makes sense. Right. That's a benefit too. Sure. Especially maybe they're in retirement or whatever. Maybe that cash flow is really important. Depends on where they are, what their goals are. Right. Well, a recasting says, okay, you take that big chunk, that $100,000. By the way, typically a big chunk does have a definition. It's usually defined as 10% of the loan balance or more. Okay. No, they're not going to do this. You don't send in $100 and they're going to recast. Right. Okay. They're not going to do that. You got to do a big number here. And so they apply that. You do call the loan servicer before you do this. They apply that loan principal reduction, and then they'll respread it over the remaining life of the loan. it's easier to explain in 1 year increments. So let's say after 1 year, so you've got 29 years left, they apply this big chunk principal, and they'll re-spread it over the remaining 29 years. The result is the payment's going to drop. So that has a benefit too. So it depends on what their goals are. But the reason I share that is because sometimes these folks, when they're buying before they sell, everybody's got a different goal, but it lets them know that, hey, there's a volume knob and you can kind of turn it downward if you wanted to. By the way, I should probably say this. Some loans do not allow for recasting. Some jumbo loans do not. Some do. It does vary. But all conforming loans do.
All right.
Interesting.
So there's a couple of little nuances to it.
Well, another thing, I'm going to throw this one at you. So I have quite often heard from people, well, we can go ahead and buy because they feel like they can carry both loans. They feel confident they have the cash flow. But I always send them to you and tell them that it's not just cash flow. It's not just that you can make the payment. There's more to it when you're purchasing the second home. There's debt to income ratio. There's more. Can you elaborate on that?
Yeah. So when somebody buys before they sell, I have to be able to qualify them. I mean, it's just a fact. So, and what does qualifying means? Well, largely, and you've said the phrase, the debt to income ratios are very important. That's important. Yes, they have to have a certain credit score. And yes, we have to show that they've got a certain amount of down payment. But can they qualify to basically, very simplistically, we take what their income is per month, gross number, not what they take home, but the gross number. You remember there's the amount your employer says they pay to you, but they lie to you. And then you really get this, the gross versus net. We know you have to live on the net, but the gross is what all mortgage lenders use. We take that, and then we take all of their expenses. So their current mortgage, their current property taxes, home insurance, if there's any HOA dues, the mortgage on the new house, taxes, insurance, maybe if they have a car payment, student loan payment, whatever they have on their credit report, just on their credit report, we add those up and we divide that into their gross monthly income. And it gives us a ratio. And there's certain numbers we're looking for that are not dictated by us. They're given to us by Fannie Mae and Freddie Mac, FHA in certain cases. And so that's exactly right. Is even though they may go, oh, I can stretch it. Well, I would love to help you stretch it. But if the numbers don't work, I can't make it up.
And you're not sitting there making up your desk, making these numbers up, making these qualifications up. These are dictated to you.
I don't just get to go, you get one, you don't get one. No, I don't get to do that.
I give it to everybody.
I have to make sure the numbers work. That's right. And what we do then is if they don't work, well, then we look at, is there a way, are there levers we can push and pull to get there? Give an example. Sometimes I'll say, well, okay, the debt ratio is a little high. Doesn't quite work. But maybe we're close, and I'll look at what their other liabilities are, and I'll go, hey, what if you've got some money here, you only owe $7,000 on that car loan, which I'm making it up. Well, what if you went and paid off that car? That'll eliminate this payment. Maybe they did a 3-year car loan, so the payment's kind of high. That'll take that out of the debt ratio, and maybe the debt ratios would work just fine. And so those little tricks we can sometimes play, not every client.
Well, and I will say this is why I always encourage buyers to call your lender or Harold. I always recommend Harold. Call him and let him talk through your finances with you, because sometimes you may not think you can buy when you can. He may have some solutions for you. Sometimes people feel like it's too early to call you. And I tell them, and I'll tell you now, it's never too early to call Harold, because he can help you strategize and think how to get yourself in the best place to get the best loan product possible.
I am very glad you brought that up, because I get asked that question a little bit, or I'll just be out talking to somebody, out and about, and they'll say, yeah, I think I'm going to buy maybe in about 9 or 10 months. And so I'll call you then because it's too early. And I'll say, hey, call me when you want, but let me tell you what I would highly recommend is let's go ahead. It doesn't cost them anything to get pre-qualified, pre-approved. I would way rather do that very, very early so that we can look at it, figure out if there's a strategy. Is there anything we need to adjust between now and when they buy? Maybe there isn't. Great. Then we just know, okay, we're good to go. Let's not change anything. Or oh, wow, there's one little thing we ought to fix so we can be in a position. And I think we've had this happen before where I have received a phone call, and here's how it kind of played out. The person calls, they're super excited, and they go, we are ready to buy. We've been waiting for this time. We're ready to go. We just paid off all our student loans. We're so stoked. Okay, I'm like, okay, well, good. I got to compliment them.
Yes,
great. I'm
good.
glad you paid off your student loans. I'm thrilled for you. And so I'll say, well, here, let's talk. Let's figure it out. So we'll talk about their income, and I'll say, so what are y'all thinking about for down payment? And there's this awkward pause, and they'll say, well, we just paid off our student loans. Like they're like,
right.
And I know what that means.
Yeah.
They have very little.
Right.
And so we're in a situation where it's really difficult sometimes. So I usually want to talk through that. I'm not trying to condone student loans. That's not my point.
Right.
But like that's just a good
it's just
example.
part of
The payments
strategy.
are relatively low. And so maybe we're better off to have some student loan or whatever it is and have some ability for down payment.
Right.
So I'd rather talk about that front
Early.
side, early, than later.
Yeah, absolutely. Don't wait till you're ready to pull the trigger. Do it before.
Right. And it may be fine, but I don't know until I look at it.
Yeah. We used to have a saying, and I was in the Army, good initiative, bad judgment.
Exactly.
And not that that's bad judgment, but it's uninformed judgment.
Yeah, I just made
you don't know what
was
you don't
a better
know.
That's exactly right.
So, and we try to get people, if it's a year, like you're talking about, a perfect time to go talk to them.
Yeah, and we just hang on to it, and when they're ready.
Yeah, well, it gets you.
And a lot of times, a common thing I'll hear when I talk to people is like, oh, wow, this is better than I thought.
Mm-hmm.
Right.
Because we'll run some what-if scenarios, and I'll go, okay, well, when you're ready. And a lot of times they go, oh, I'm more ready than I thought I was.
Right.
I hear that a lot.
And what I hear often is, well, Harold approved me for this much, but I don't want to go that
Right. And that is very common.
And that's okay, too.
Right. We will show you, because people do wonder, what is the max I qualify for? And for most clients, it's an obscene number that would totally freak you out. And I'm not trying to condone that at all. But people are just curious.
Right.
So then when they go, okay, but I feel good here, that's most common.
Okay.
And we will always work with where you want to be.
Right.
Yeah,
for sure.
absolutely.
For sure.
Good to have somebody on your side who knows what they're doing.
Well, we try.
Well, thank you. This was super interesting.
You bet.
Appreciate that. And we hope this was a help for you. If you have any more questions, give us a call or give Harold a call.
Yeah, happy to help.
Thanks.